Today, Central Bank Fest, the DFA daily to the 23rd of September 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the latest from the Federal Reserve as they hint tapering may start soon. We look at warnings from the Reserve Bank about high household debt and the housing market, and messages from the Reserve Bank in New Zealand where they're planning a tightening of LVR restrictions. But first, the Federal Reserve Chair Jerome Powell said the US Central Bank could begin scaling back asset purchases in November and complete the process by mid-2022, after officials revealed a growing inclination to raise interest rates next year. Powell explained the US Central Bank's first steps towards withdrawing emergency pandemic support for the economy, and that tapering could come as soon as the next meeting. That refers to the policy gathering on November the 2nd and 3rd, though he did leave the door open to waiting longer if needed and stressed that tapering was not meant to start a countdown to lift off from zero interest rates. Actually, it was all a bit fluffy in my mind. The FOMC median projection for 2022 inflation rose to 2.2% from 2.1% in June, but they held the 2023 forecast at 2.2%. Unemployment is expected to be 3.8% in 2022 and 3.5% in 2023, and no change from the June forecast. And the GDP growth was seen to be 3.8% in 2022 and 2.5% in 2023, both higher than the prior projections. So they must be assuming that Delta will be under control soon. The US employment rate fell to 5.2% in August. That was well below the 2020 peak of 14.8%, but it's still above the 3.5% rate that prevailed in February 2020 before the pandemic struck. And Fed officials say that they expect to keep the funds rate near zero until labour market conditions have reached levels consistent with the committee's assessment of maximum employment. Inflation, according to the Fed's preferred measure, was 4.2% in the 12 months through to July, well above the central bank's 2% target. And many Fed officials have said that they expected to return to around 2% after temporary supply chain disruptions resulting from the pandemic have been resolved, though several have also cited the rapid price increases as a reason to begin raising rates as early as next year. The timing and pace of coming reductions in asset purchases will not be intended to carry a direct signal regarding the time of interest rate liftoff, he said, following the two-day meeting. Powell said he didn't expect the Fed to begin rate increases until after completing the tapering process, which could wrap up sometime in the middle of next year. It's a bit faster than the last cycle, said Jim O'Sullivan, TD Securities' chief US macro strategist. He was very clear in the press conference that soon means November. The Fed took 10 months to complete the exercise of scaling back bond buying in 2014, then of course started to reverse it once again. Powell's performance was being parsed both by investors and the White House. The central bank chief's term expires in February, and President Joe Biden is expected to decide this fall whether or not to renominate him to another 4 years in his post. In fact, the White House aides are considering recommending the president keep him on the job. In addition to signalling a scale back in upcoming bond buying, officials also published updated quarterly projections, which shows officials are now evenly split on whether or not it will be appropriate to begin raising the federal funds rate as soon as next year, according to the median estimate of the FOMC participants. In June, the median projection indicated no rate increases until 2023. The projections are not a policy commitment and reflects the personal views of policymakers, some of whom may no longer be serving at the Fed next year. Biden's expected to fill an open slot on the 7-seat board in Washington, as well as naming 2 new vice chairs when the terms of the current incumbents, Richard Clowder and Randall Quarles, expires in coming months. The chairman is a dove among hawks, said Diane Swank, chief economist at Grant Thornton. He would like to divorce tapering from liftoff and stressed the threshold for rate hikes is much higher than that of tapering. The US rates market continues to price in the first hike around the start of 2023, although the 5-year Treasury rate rose as traders anticipated a slightly more aggressive path once benchmark increases began. That helped flatten the yield curve at the long end, and rates fell, and the dollar index gained after being whipsawed around after the decision. US stocks just pared their advance a little. The muted market reaction is a very good outcome for the Fed in terms of signalling their intent to get the market information out well ahead of the tapering decision, said Jeffrey Rosenberg, Senior Portfolio Manager for Systemic Fixed Income at BlackRock. The Fed has to be pleased that their communication on the long-awaited tapering has avoided the dreaded fear of the tantrum. The FOMC decided to maintain the target rate for its benchmark policy rate at 0 to 0.25% and continue purchases of treasuries and mortgage-backed securities at a pace of $120 billion a month. That vote was unanimous. Projections for 2024 also published for the first time, with the median suggesting a federal funds rate of 1.8% by the end of that year. The median for 2023 rose to 1% from 0.6% in the June projection. A small upward revision for 2022 inflation suggests the Fed is holding to the transitory hypothesis and expects price pressure to converge closer to its target next year. Still, the hawkish shift on the dot plot suggests that for now, it's concern about price stability that is the greater focus of attention for the FOMC. And participants generally expect a gradual pace of policy firming that would leave the level of the federal funds rate below estimates of its longer run rate level, Powell said. This is not a dovish outcome, but it is not an aggressively hawkish outcome either, Krisha Gua, head of central bank at Evercore ISI, wrote in a note. The equity market looks to have been taking its early cue from the upbeat 2022 growth outlook and lack of a clear break to a 2022 hike. The Fed also said it would double the per counterparty limit on its overnight reverse repo agreement facility to $160 billion a day. That's a significant change, and it shows that yet more funds are flowing back to the Fed from the banks. Now, here in Australia, risks to financial stability could be building as house prices and debt levels keep rising, according to the Reserve Bank. Oh, have they finally woken up? Well, not sure. Michelle Bullock, Assistant Governor of Financial System at the Reserve Bank, reflected on the housing market and its effects on the financial stability during a recent address. She noted that house prices have had a strong recovery following an initial modest decline at the onset of the pandemic, particularly in detached dwellings. It's been driven by low rates, home builder and rising prices. Growth in housing credit is currently running at an annualised rate of around 7%, with the RBA expecting it could peak at around 11% early next year. Ms. Bullock commented that the housing market strength is a positive for the economy and an important contributor to economic growth, but there may be risks bubbling under the surface. While household debt to income in Australia hasn't increased much over recent years, it is at a high level, both historically and relative to other countries, she said. So sustained strong growth in credit in excess of income growth may result in vulnerabilities building in bank and household balance sheets. The RBA had previously signalled that it was monitoring the housing and lending markets with APRA, with both regulators discussing what tools they would use if they felt they needed to intervene. APRA recently recorded a rise in high debt-to-income lending, with Chair Wayne Byers expressing concern. The share of new lending at high loan-to-value ratios also rose in 2020, reflecting an increase in first home buyers with lower deposits, Ms. Bullock reported. She confirmed the Reserve Bank is yet to see a decline in lending standards from the banks, but alongside APRA, it is monitoring these trends closely. Unlike in 2014 and 2017, the concern this time are not specific types of lending, such as investors or interest-only lending, so the tools used at that time are not really appropriate at this time, Ms. Bullock said. This suggests that if there were to be a need for so-called macro-prudential tools to address rising rates, they should be targeted at the risks arising from highly indebted borrowers. Tools that address serviceability of loans and the amount of credit that can be obtained by individual borrowers are more likely to be relevant. Previously, RBA Governor Philip Lowe has said the central bank and APRA have considered limits on high loan-to-value ratios or debt-to-income lending in banks' portfolios. Around 60% of the bank's lending is for housing, leaving them highly exposed. Housing is also common collateral for loans to small and medium businesses, with a correction or a decline in housing prices potentially shaking the value of that collateral. If there were an economic shock that resulted in borrowers being unable to service their debt, however, and at the same time housing prices fell sharply, the debt would be unable to be recovered in full by the sale of the property, resulting in the loss to the banks, Bullock said. If the losses were large enough, the banks might exacerbate the decline by reducing their lending. However, the banks have built up their levels of capital to stronger positions than they had at the time of the global financial crisis. Indeed, stress tests undertaken by the Reserve Bank and reported in October 2020 indicate that even in a very severe recession and substantial fall in property prices, that would still leave the banks with capital above their regulatory minima, Bullock said. The strength of the banks allowed the banks to respond positively to the pandemic shock, supporting the economy through lending and loan repayment deferrals rather than amplifying the shock. The economy could remain vulnerable to high levels of household debt if it dampens consumer spending. Over-exuberance in the housing market can amplify these risks in two ways, she said. First, rapid price rises can increase the likelihood that some new borrowers will overstretch their financial capability in order to obtain a new loan, making them more likely to reduce their consumption in response to a shock to their incomes. And second, if rapid price rises ultimately prove to be unsustainable, they could lead to sharp declines in price and turnover in the future. This in turn could result in reduced spending both directly as a result of a decline in turnover and through a wealth effect. The past evidence suggests households with higher levels of debt are more likely to curb consumption in response to shocks to income or wealth, whether it's through loss of employment or reduced hours. And the RBA has warned a large number of households following that behaviour response could amplify the economic shock. A boom in the housing market accompanied by an increase in housing debt could therefore make the economy more susceptible to downturns, Bullock said. Further, the RBA is closely watching investor activity in the housing market, although it is not near previous highs that they were in 2014, when APRA introduced its investor lending benchmark. Investors have the potential to amplify movements in house prices, buying when prices are rising quickly but potentially selling when they fall in an effort to avoid capital loss, she said. Any amplified swings in housing prices will have an impact on the wealth of all households and hence potentially their consumption. Point here, of course, is that she's not going to sufficient granularity with regard to households. You need to go into segmented analysis because some households are already in difficulty, others are not. The other point is that the Reserve Bank is reliant on old, out-of-date Hilda data and also myopically selected data from mortgage-backed securities. Unfortunately, they don't have a very good view of the truth out there, and the risks are very high, as I reported recently in my latest stress analysis. The fact is, RBA and APRA are part of the problem, but at least I suppose they're calling it out. But in a way, it gives them a chance to say, well, we told you so, despite the fact that their policies created the problem in the first place. Now, elsewhere, the Reserve Bank in New Zealand will proceed with its proposal to tighten loan-to-value ratio restrictions on lending to owner-occupiers to reduce risky mortgage lending. From 1 November 2021, they will restrict the amount a lending bank can do above an LVR of 80% to 10% of all new loans to owner-occupiers, down from 20% at present, according to Deputy Governor Jeff Bascard. We launched a consultation back this month after observing that despite previous adjustments to LVR restrictions, house prices remained unsustainable and the risks of a housing market correction had continued to rise, increasing risks to economic and financial stability. Restricting high-risk lending will help prevent these problems from getting worse, they said. Submissions from industry representatives were largely supportive of the proposal, with respondents recognising the need for further tightening in order to help control house price inflation and mitigate potential risks to financial stability. Feedback from members of the public was mixed, with some submissions supporting the proposals and others questioning the need for further restrictions or arguing for other policies to protect the financial system. We'd like to thank everyone who shared their feedback during the consultation process. We've published a summary of submissions received alongside a regulatory impact statement, they said. The consultation proposed implementation of the new LVR settings from 1 October. However, given the disruptions from heightened COVID alerts to customers and banks managing or completing purchases associated with existing pre-approvals, they're delaying the implementation to 1 November. and they expect the banks to comply with the spirit of the new restrictions immediately, however, and the proposed policy changes will take effect by altering banks' conditions of registration. There'll be a short consultation on the required changes to that, which will be launched shortly. So it's interesting that in New Zealand, the Reserve Bank there is very clear about the risks from housing, and they're tightening. RBA, please note. And finally, just on the markets, the S&P 500 rallied on Wednesday, shrugging off that Federal Reserve signal about tapering the bond purchases. The S&P 500 rose 1%, the Dow Jones Industrial gained 1.1%, and the Nasdaq climbed 1%. Leading up to the meeting, however, many analysts were of course betting on the November taper and suggested that announcements will be priced in. Cyclical sectors including energy climbed by more than 3%, underpinned by rising oil prices following data showing weekly US oil supplies fell by more than expected last week. Crude oil inventories fell by 4.7 million barrels, compared with analyst expectations of a draw of 2.4 million barrels. Sentiment on oil has also been supported by news that the OPEC countries of Nigeria and Angola and OPEC Plus member Kazakhstan have lasting difficulties expanding their production due to a lack of investment. In a further boost to sentiment on cyclical stocks, those that move in tandem with the economy, China contagion fears subsided after Evergrande agreed to settle interest payments on the domestic bond on Wednesday, and the Central Bank of China pumped further liquidity into the financial system. And in big tech, Facebook was down 4%. That was a drag on the sector after the social media giant warned that Apple ad tracking would hurt growth. The Volatility Index was down 14.33% to 2087. Gold futures for December delivery was down 0.6% to 1,767. Crude oil for delivery in November rose 2.1% to 71.97, while the euro-US dollar was down 0.26% to 1.1693, and the US dollar index futures was up 0.26% to 93.42. And finally, in crypto land, both Bitcoin and Ethereum moved higher, having had a torrid few days. So standing back, central banks are still making calls based on their view of what the economy is doing, what it should be doing. Trouble is, I wonder how closely they really understand what's going on, and also whether they will be able to really reduce their stimulus, particularly through quantitative easing. And of course, the risks in the housing market here in Australia continue to build because both the RBA and APRA remain asleep at the wheel. That is a big problem for us because we know that things could go pear-shaped quite quickly. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.